The price is lying and the spread is telling the truth. And that's why this silver snap move isn't done yet. Silver just did that thing it only does when the market plumbing is under stress. It rips higher, it whipsaws hard enough to humble everyone, and then it refuses to fully give the move back, even when the headlines try to talk you into believing it was just a spike. Cheers! And here is the conflict you need to clock right now. The crowd is staring at the screen price like it is the only reality, while the people who actually have to source, hedge, move, and settle metal are watching a different scoreboard. That's where the real pressure starts. Because if the near-term structure stays tight, the market isn't debating whether silver is overbought. It's debating who can afford to stay short, who can afford to wait, and who is quietly forced to pay up for time. And later in this video, I am going to give you the exact what to watch next checklist for the next 1 to 2 weeks. Levels, confirms, invalidation, and the one calendar window that can turn this from a fast move into a violent move. Let S get something straight right away. This isn't too much about being bullish because you like shiny rocks, and it's not about being bearish because you think everything is a hype cycle. This is about mechanics. It is about what happens when silver stops trading like a polite macro proxy and starts trading like a settlement problem with an attitude. If you're only watching spot, you're going to get emotionally farmed. That's not an insult, it's a warning. The tape is designed to make you do the wrong thing at the worst possible moment. And silver is the perfect instrument for that, because it has two personalities. It can trade like a monetary metal when fear hits, and it can trade like an industrial input when procurement tightens. When those two personalities sync up, you get the snap. Here's the live context, so we're not talking in vibes. As of January 19th, 2026, spot silver is sitting around the low to mid $90 handle, roughly $93 an ounce on the live quote. That's not a typo. And if you zoom your brain back to the start of this month, you are looking at a move that started the year in the low 70s and then accelerated, mid-month prints pushing into the low 90s before the inevitable whipback. In other words, this isn't a slow grind. It's a regime change in speed. And speed matters because speed changes who participates. Slow trends are owned by patient money, fast moves are owned by forced money, but that's not the part that matters. The part that matters is what the market is paying for underneath the headline price. Because silver's truth serum isn't the dramatic candle on your chart. It's the way the curve behaves. It's the way nearby liquidity behaves when you would normally expect it to relax. It's what happens in spreads when the tape tries to shake you out. In a normal, loose market, the future is priced above the present. You can call it carry. You can call it storage and financing. You can call it the market pays you to wait. And when that's the dominant condition, a spike gets sold, the curve stays comfortable, and everybody goes back to arguing about RSI. But when silver is tight in the real world, when the near-term demand for metal or for deliverability or for borrow gets sharper, you get the opposite behavior. The front gets stubborn. The nearby refuses to cheapen the way it should. And even when spot gets slapped, the structure can stay tense. And that's when the price starts lying less effectively. Now, I'm not here to tell you fairy tales about a single villain behind the curtain. You don't need that story. You just need incentives. You need to know what different participants are forced to do when the plumbing tightens. Start with the simplest street symptom. The thing you can feel before the charts explain it. Physical demand doesn't behave like a chart pattern. It behaves like a procurement desk. When retail and small institutional buyers get serious about physical, you see it in the boring places. Premiums that done a T compress the way you expect on pullbacks. No. Delivery windows that stretch dealers managing inventory like they're rationing rather than stocking. And hedgers treating dips as opportunities to cover exposure instead of invitations to short more paper. And that's where the real pressure starts, because those behaviors translate into hedges, and hedges translate into futures positioning, and futures positioning translates into spreads and volatility. So let's talk about the hidden detail that reframes this whole story. Here it is, clean and simple. When silver is truly abundant and easy, the market structure usually rewards patience. When silver is tight and urgent, the market structure punishes waiting. That's it. That's the cheat code. If the near term is getting expensive relative to later months, if the curve flattens or inverts, if calendar spreads tighten, if borrowing metal gets pricier, you're not watching sentiment. You're watching a constraint. And constraints don't care about your narrative. They care about deadlines. And that brings us to why right now matters more than most people realize. Because we're not just in a big move. We're heading into a calendar squeeze window where deadlines stack on top of each other. On January 27th, 2026, a key silver options contract month has its last trade and settlement date on the exchange calendar. On literally the same day, the Federal Reserve begins its January policy meeting, with the decision landing January 28th. That's not a horoscope coincidence, that's a volatility recipe. options expiry changes, dealer hedging behavior. A Fed week changes macro positioning, dollar sensitivity, and risk appetite. Put them in the same narrow corridor and you get thin liquidity, sharper hedging flows, and bigger air pockets. If this one level breaks, the math changes. Let me translate that without the jargon. Options are not just bets, they are obligations for market makers. When open interest is heavy in certain strikes, and you can feel it in the way price snaps into levels and then ricochets, dealers are constantly adjusting hedges as price moves. That adjustment is mechanical, buying and selling. In quiet markets, it's background noise. In fast markets, it becomes a steering wheel. If price moves up through a cluster of strikes where call ownership is heavy, dealer hedges can flip from sell the rip to buy the rip, because delta changes quickly. That can create that terrifying feeling where price is rising not because everyone is euphoric, but because hedges are chasing. That's the gamma reflexivity people talk about. And you don't have to worship it to respect it. Because even if the fundamental story is the real engine, options can be the spark. And the next detail is what flips the whole setup. If spreads stay tight into that expiry window, any dealer-driven squeeze has a sturdier floor because the physical and term structure signal is already saying the nearby matters. Now layer in the other engine, short covering and margin pressure. Silver is notorious for punishing people who confuse volatility with mean reversion. Shorts look smart until they don't. And the moment silver accelerates in price, the short isn't just fighting direction. The short is fighting time. Futures shorts face daily mark-to-market. If price rises, they post margin. If volatility rises, their broker raises margin requirements. If spreads tighten, rolling the position can get less comfortable. If, on top of that, there is any deliverability fear, or even just a perception that nearby settlement could get messy, suddenly the cost of staying short isn't just the chart. It's the financing, it's the stress, it's the possibility of being forced to cover at the worst moment, and that's where the real pressure starts. Here's the trap people fall into with silver inventory. They hear there, plenty of inventory, and assume tightness is impossible. But silver inventory isn't a single pile that anyone can grab. Inventory has categories, ownership, location, and willingness. On the exchange side, there's a difference between metal that meets standards and metal that is actually registered for delivery. Eligible is not the same thing as deliverable. Eligible means it could be delivered if the owner wants to convert it and post it. Registered means it's already in the deliverable pool. That distinction matters because the market can show huge total stocks, while the deliverable slice is the bottleneck. And when deliverable is the bottleneck, spreads can tighten even with big totals. That's not a conspiracy, that's just logistics and incentives. Zoom out further, silver is global, but settlement is local. London matters, New York matters, Asia matters. And when metal gets sticky in one hub, the arbitrage that should smooth everything out can slow down because it's not frictionless. Moving silver isn't like moving digits in a ledger. It involves vaulting, assaying, transport, insurance, financing, and time. The arbitrage needs a wide enough spread to pay for all that, and it needs confidence that the trade won't get interrupted by volatility or policy noise. So when you see London Vault data showing huge holdings, tens of thousands of tons in the London system, it doesn't automatically mean the market is loose. It can also mean the metal is sitting where it's financially useful, not where it's physically urgent. And that's the tension between paper convenience and physical necessity. Look at the London Vault picture as a real data anchor. At the end of December 2025, London Vaults held roughly 27,818 tons of silver up on the month. That's enormous. It tells you the global system has a deep reservoir, but the reservoir doesn't pour instantly into every point of demand. If large portions of that metal are tied up in ETF custody institutional collateral cycles, or simply owned by entities that have no incentive to mobilize it at today's terms, then the available float can be tighter than the headline tonnage suggests. And when the available float gets tight, the curve starts behaving like a warning light. Now compare that with the COMEX side. Total exchange stocks can look massive as well. Some datasets pegged COMEX silver stocks around the mid 400 million ounce level in late 2025. Hundreds of millions of ounces sitting in approved warehouses. Again, huge. On paper, that's not empty shelves. But the market doesn't price totals. It prices marginal availability and marginal urgency. If a bunch of those ounces are there, but not for you, or not for delivery, or not for quick mobilization, then the nearby spread can still get tight. And that's where people get fooled. They argue against a tightness signal by pointing at a big number that doesn't directly address deliverability. Hit S like looking at a city, S total water supply while ignoring whether the pipes to your building are frozen. Now we need to talk about the institutional accelerant, ETF flows. This is where things can turn from tight into chaotic. When investors pile into physical-backed silver ETFs, the creation mechanism can force real metal to be sourced and allocated, often in the London ecosystem. In calm times, that's manageable. In a market that's already tight at the margin, ETF demand can become the straw that turns a tight curve into a screaming curve. Recent reporting has pointed to very large inflows into the biggest silver ETF over a short period, on the order of almost $1 billion in about a week, with implied volatility spiking to the highest level since the early 2020s. You don't even have to treat that as gospel to understand the mechanism. Rapid inflows create a sourcing problem, and the sourcing problem shows up as tighter spreads, firmer premiums, and more frantic hedging. And the next detail is what flips the whole setup. ETF flows don't need to be permanent to matter. The flow itself creates the pressure because the metal has to be found now. This is also where silver's supply chain reality kicks you in the face. Silver is not oil. You don't just turn a valve and get more. A huge chunk of silver supply comes as a byproduct of mining other metals: copper, lead, zinc, sometimes gold. That's the byproduct trap. It means the silver supply response is slow and indirect. Even if the silver price screams higher, you don't instantly get a flood of new silver ounces unless the economics of those primary metals also cooperate, unless refineries have capacity, unless scrap recycling ramps, unless logistics loosen. And that takes time, so demand can surge faster than supply can respond. That mismatch doesn't have to be permanent to cause violent price discovery. It just has to exist during a calendar window when obligations come due. And let's not underplay industrial demand, because it's the quiet bid that never tweets. Silver isn't just money metal, it's an industrial input. Electronics, solar, electrification supply chains, medical applications, specialty alloys. Industrial demand doesn't chase price the way retail does, but it also doesn't vanish because the RSI is high. Procurement desks care about continuity. They care about not being caught short of input. If they sense tightness, they hedge and they stock. And when they hedge, they add to the same paper market that speculators are using. That means the weirdness of silver, both the fear trade and the factory trade, can meet in the same instrument, but that's not the part that matters. The part that matters is what that forces participants to do during the next couple weeks. So here is the live why now setup in one sentence. We have a market that has already proven it can move tens of dollars in a short window, heading into an options expiry and a major policy week with structural signals that can stay tight even during pullbacks. That is exactly how you get a snap move that doesn't die. And if you're thinking, okay, but surely it's already priced? Remember, what's priced is the consensus narrative. What's not priced is the nonlinear behavior that shows up when hedges and deadlines collide. Now let's build the proof stack, because we're not doing this on one pillar. Pillar 1 is the chart reality. The month started around the low 70s and ran into the low 90s, with spot around $93 a day and an intraday range that S wide enough to break weak hands. That's a trend signal, plus a volatility signal. Pillar 2 is term structure behavior. When the nearby refuses to discount and spreads tighten, it hints that time is getting expensive, meaning urgency is rising. Pillar 3 is institutional flow. Large ETF inflows and elevated implied volatility change the sourcing and hedging landscape quickly, even if the story cools later. Pillar 4 is physical plumbing. The split between headline inventory and deliverable or mobilizable inventory can create bottlenecks without any shortage myth. Pillar 5 is macro stress, when policy credibility and dollar confidence wobble, even just in perception. Precious metals get bid as a hedge, and silver tends to exaggerate moves because it's smaller and more volatile than gold. And if you want a sixth layer, it is the calendar itself. The January 27th options date colliding with the January 27th to 28th Fed meeting window, right as month-end positioning and roll behavior can thin liquidity. That's your stack. And that's your case. And the next detail is what flips the whole setup. A stacked case doesn't always D mean a straight line. It means a higher probability of violent zigzags with an underlying bias. Now let's get very practical, because you're not here for poetry. You're here for what do I watch and what would make me change my mind. First, respect the difference between trend and noise. In a snap regime like this, noise is the intraday murder candle that exists purely to trigger stops and force emotional decisions. Trend is what remains after the candle. Trend is the market's ability to reclaim levels quickly after pullbacks, and to hold higher lows even when the headline mood turns sour. So your job is not to predict every wiggle. Your job is to identify the level that changes behavior. Here's how to think about levels without pretending we can call the exact tick. Silver just printed into the low to mid 90s zone. That zone is psychologically loud because it's a roundish milestone and because it's where volatility has been concentrated. If spot can hold above the high 80s on pullbacks, call it the 88 to 90 region, as the first line in the sand, that tells you the market is digesting the move rather than unwinding it. If it loses that zone cleanly and then fails to reclaim it quickly, that's a warning that the snap is cooling into a deeper mean reversion phase. But if it tags that zone and rebounds hard, that's confirmation that buyers are using pullbacks as inventory opportunities. And that's where the real pressure starts. Now let's go one layer deeper. A controlled pullback is not a failure. It's actually healthy if the underlying structure remains tight. In commodities, the best moves often retest. They retest because the market has to find out whether the demand is real. If the move is just hot money, the retest fails. If the move is structural, the retest holds. So your base case scenario is a controlled pullback and retest. Silver dips, everyone declares the story over. Volatility spikes, weak hands puke, and then the market stabilizes, holds higher support, and grinds back up. That's scenario one. Scenario two is the one people underestimate because it feels too wild until it happens. Continuation squeeze and gap risk. That's where the market doesn't offer the clean retest. It compresses. Spreads stay tense. Options hedging turns into forced buying, and price gaps over resistance and thin liquidity, often during a time window when you least expect it, like an overnight session or around a macro headline. That's scenario two. And here's the key. Both scenarios can happen while your thesis remains correct. The difference is the path. That's why risk framing matters. Because the market can whip around violently, even if the underlying tightness is real. If you treat every pullback as a betrayal, you'll self-destruct. If you treat every rip as permanent, you'll also self-destruct. The market wants you emotional. Don't give it that. Okay, now let's talk about what confirms and what invalidates, using actual mechanics rather than vibes. Confirmation looks like this. You see pullbacks that get absorbed quickly. You see the nearby structure remain firm. You see the market behaving like time is expensive. You see continued evidence that physical demand is sticky, premiums, and availability not collapsing on dips. You see ETF holdings or inflow chatter remain supportive. You see volatility stay elevated in a way that signals active hedging rather than dead interest. That's confirmation. Invalidation looks like this. The curve relaxes materially, meaning the market is once again paying you to wait. Spreads widen back out in a comfortable way. Physical premiums collapse. Availability normalizes quickly. ETF flows flip hard the other way. Spot loses the key support zone and fails to reclaim it for multiple sessions. That would tell you the snap was more about a temporary panic bid than a structural shift. And that's not a moral judgment. That's just the tape changing its mind. Now, I want to address the elephant in the room that every silver skeptic brings up. If it S-tight, why are there so many ounces sitting around in vault data? Well, why? And it's a fair question. Here's the honest answer. Tightness in commodities is often about float, not totals. In finance terms, it's S about what S available at the margin at the price and time you need it. A lot of silver can exist in the world and still be hard to source quickly in the form, location, and legal settlement status that a specific obligation requires. That's why term structure and spreads matter, because spreads are where the market prices urgency. If a buyer needs metal now, they'll pay up in the nearby. If a seller can only deliver later, they'll discount the future. That tug of war is the curve, and when the curve gets weird, you pay attention. Now bring the macro overlay back, because silver doesn't trade in a vacuum. There's been a lot of tension in early 2026 around rate expectations and central bank independence narratives. And when those narratives flare up, the dollar can wobble and real asset hedges catch a bid. Gold has been on a tear in that environment, and when gold rips, silver often follows, but with leverage-like behavior. Silver is smaller, silver is thinner. Silver has industrial demand. It can overshoot, it can undershoot. That's why your emotional discipline matters even more here, because the market will use volatility as a weapon. It will rip it up, then slam it down, then rip it again, all while the structure quietly stays tight. The goal is simple, to separate you from your conviction and hand your position to someone with a calmer nervous system. Don't fall for it. Here's the psychology shield, the thing I want you to literally repeat when the tape starts screaming, noise is designed, trend is earned. If you see a brutal red candle in silver during a snap regime, your first question shouldn't be, am I wrong? Your first question should be, did the structure change or did liquidity thin? Because those are different things. Liquidity can thin without the thesis dying. Options hedges can force moves without the thesis dying. Margin calls can force moves without the thesis dying. But if structure changes, if spreads relax, if the curve normalizes, if the market stops penalizing waiting, then you reassess. That's being rational, not stubborn. Now let's talk about the next 1 to 2 weeks like a tactician. The calendar is doing something rare here by stacking multiple catalysts. You have the end-of-month positioning effect, which matters because funds and systematic strategies can rebalance exposure into month end, and because risk managers tighten when volatility spikes. You have a major policy meeting window at the Fed on January 27th, 28. You have the options expiry dynamics around that same late January date. And you have a market that is already in a high vol regime. That combination creates two specific risks: gap risk and headline whipsaw. Gap risk means you can wake up to price having moved through your level without trading cleanly through it. Headline whipsaw means a single macro line can push the dollar, yields, and metals quickly, and the options market can amplify it. So what do you actually watch? Number one, does silver hold the high 80s to low 90s zone as a floor on pullbacks? Does it reclaim it quickly if it gets lost intraday? Number two, do you see the market acting like time is expensive? Nearby firm, deferred not running away, structure not relaxing? Number three, do you see signs that the physical bid is still sticky? Premiums not collapsing, availability not suddenly flooding? Number four, do you see volatility staying high in a way that suggests active hedging, not everyone left? Number five, do you see gold and the dollar behaving in a way that supports the macro hedge bid rather than smothering it? And number six, the sneaky one, do you see the tape doing that fake breakdown behavior where it breaks a level just long enough to trigger stops and then reverses hard? Because that's a signature of a market where forced flows are active. Now, if you're the type who needs a target, here's the honest way to treat targets in a snap regime. Targets are less important than levels that trigger forced behavior. The big psychological zone above the low to mid 90s becomes the next battleground. If silver can accept above that zone, meaning it trades there, consolidates there, and stops rejecting, it opens the door to a continuation leg that can look absurd on a linear chart. That's not a promise. It's a mechanic. Acceptance creates new hedging needs. New hedging needs create demand. Demand in a tight structure creates squeezes. But if it fails there and starts rejecting hard, meaning it can't hold gains and sellers keep slamming it, then you're in scenario one, the controlled pullback and retest phase where patience and discipline beat hero calls. And if you want one clean invalidation marker, one line that tells you the tightness narrative is fading, it's this. If the market starts paying you to wait again in a clear way, if the curve relaxes, spreads widen, nearby loses its premium, then urgency is fading. Not necessarily the whole bull case, but the snap move engine, because snap moves are fueled by urgency. When urgency fades, snap turns into grind. And grind is a different game. Now I'm going to say something that might annoy both camps, and that's how you know it's useful. Bulls, you don't have to predict a straight line to be right. Bears, you don't get to declare victory just because silver drops $4 in a day in a regime where $4 is now normal. This is a different volatility environment. And a different volatility environment means your old emotional reactions are outdated. In the old regime, a $2 down day might have meant trend broken. In this regime, it might mean Tuesday. So you have to update your operating system. That's the viewer psychology shield in practice. And here's the subtle CTA, because I'm not going to beg you for anything, but I am going to set a standard. If you were still watching silver like a meme chart, you're going to keep getting whipsawed. If you're watching it like a market structure story, curve, spreads, inventory categories, flows, calendar, you're playing the adult game. So stick around, stay mechanical, and compare notes with people who actually care about the plumbing. That's how you don't get played. Let's close with the two scenario roadmap, clean and actionable, so you can stop guessing and start monitoring. Scenario one, the base case. Silver pulls back into that high 80s to low 90s area. It wicks lower to scare you. Then it stabilizes, holds higher support, and starts climbing again as the calendar window passes and the market digests the move. Confirmation is quick reclaim behavior and structure staying tense. Invalidation is a sustained breakdown with failed reclaims and clear structural relaxation. Scenario 2, the squeeze case. Silver doesn't give you the clean retest. It compresses. Options hedging turns into forced buying into late January, and a macro headline or policy surprise triggers a gap move through resistance and thin liquidity. Confirmation is acceptance above the recent highs and continuation without immediate rejection. Invalidation is a blow-off spike that immediately collapses and then fails to bounce. Classic exhaustion behavior. Either way, the mission for the next 1 to 2 weeks is the same. Don't let volatility steal your position. Don't confuse noise with signal. Don't fall in love with the narrative. Fall in love with the checklist. Because the moment you stop needing the market to behave, you become the person who can actually ride the move when it matters. And if that one late January window hits with spreads still tight, the market won't need your permission to move. It'll just move.